exactly what you make of it. You can make a big deal out of it or a little deal out of it. So luckily, I'm a really loud talker. My family tells me that daily, and so do my coworkers. So you guys get to experience this. We are going to go live. In fact, we're probably a minute late, but we are live on Facebook and on Zoom. We have hundreds of real estate agents that are joining us for our typical Thursday market update, but we're doing it here with you in person. Now, they're not going to experience Mike Sherrard and the second half of our time together, but they are going to get the market update. So I am going to jump in, but I wanted to first kind of say thank you for coming. Like, welcome. What an incredible time, right? So, oh, am I not on my, okay. All right, so I just wanted to say that this is the beginning of something new. We all know the market is turning in ways that we can't foresee. And as soon as we think we got to figure it out, it does something different, right? So we're all scrambling, trying to figure out how do we communicate this and educate our clients. And we're going to get into that. Megan is going to do a phenomenal job of updating us on the market trends. I'm going to jump in with some of the things on the economics. But first, I just wanted to tell you that today is the beginning of something new for Agent Ignite. So we were in this room last year when Agent Ignite butted heads with Building an Investment Empire. For those of you that were here with us, we had my CPA, my financial planner, and my project manager, and it was a phenomenal time. This time, Agent Ignite is going to butt heads with the next big thing with Mike Sherrard. And next year, we're going to do even more of that. So really quickly, I just want to share with you, we are going to be doing Agent Ignite no longer monthly, but twice a year. And we're going to do 3 hours and bring in several speakers, making sure that it's pertinent to your business at that time. So we're going to do that. And then next big thing, we're going to have the next one. It's going to be a one-day event instead of 2 so that more people can come. It's going to be down in the tech center so more people can come. And then we're going to do a second one-day event. So we're going to have 2 one-day next big thing events, 2 Agent Ignite events. We're also building a new website with all the content we put out on a regular basis, accessible by you guys. Really quick, really easy. Our whole thing is, how do we help you reach more clients? How do we help you be more successful? How do we help you know the market so that you can help them determine the best decision for their clients, their families, right? Financial wellness. We believe in real estate. We believe in the power that it brings a family. We believe that this is the path to financial freedom. I know I do, and I think that that's why you're joining us in this room. So with that, Miss Megan, I'm going to start us out with our quote, and you're going to take over. So here's our quote for the day. Excellence is never an accident. It's the result of high intention, sincere effort, intelligent direction, skillful execution, and the vision to see obstacles as opportunities. My Mike, this market, obstacles as opportunities. This is our time to shine, but you got to keep smiling and you got to have a good time with it, because the moment you get dopey and dreary, your clients aren't going to want to work with you. Megan, let's see what you got.
All
I know
right.
it's good.
I don't know
Can
that I
you
can
do
get
it?
up on stage. Raise your hand real quick. Sorry about that, guys. I don't know that my mic is working either, but I can talk loudly. Can everyone hear me okay? Awesome. Well, it's really nice to see you. Is there anyone in this room who has never seen a market update from me before? Because when I added a bunch of people to my list this week for the registration so that you guys all get a copy of my distribution, I added like 100 people, and it's been a long time since I added 100 new people to my distribution. So thank you very much for showing up today. I appreciate it. Now, in this room alone, we have 200 people, and online we have another 600 people that are joining us. So I appreciate you guys taking the time out of your busy days in order to come in and learn about what's happening in the real estate market, because the market is shifting on us pretty significantly. And if you think back to where we were January, February, March, and April, this is the market that we've been praying for 2 years. So go ahead and enjoy it, okay? You're no longer at the mercy of what hits the MLS every single morning. You're not having to leave the office at lunchtime to try and get out there to be the first one into a home to show a property. But now you're able to time block and better set your schedule so that you can get your buyers into those homes over the weekends. And those homes are hanging out for longer than 1 or 2 weekends right now. But it does shift the way that you have to market yourself and the way that you have to market those properties. If you think about the psychology of buyers right now, a lot of buyers that are in the market now started back in the market in January and February, where they probably lost out on 5, 6, 7, 8, 9 deals before they're able to get something under contract. And all along the way, they've been watching home prices appreciate and interest rates go up and their affordability going down. So they're frustrated. So it's really imperative right now that you're taking the time to stage your listings, to take great photos of those properties, to give it great curb appeal, and to make it as show ready as possible, because those homes that are not having those great photos or staging, or if they sit on a busy street, or if they have lime green walls, they're hanging out in the market right now. So it's really important that you're making your home show ready, because buyers are frustrated right now. Hopefully they're able to get into something. And what's great is looking at the contracts that are coming into the title company, I'm seeing contingent offers being accepted. I'm no longer seeing those appraisal gaps going over asking price. I'm no longer seeing inspections waived. So it's a great market for you to have some negotiating power in. And I would highly recommend that if you had buyers back in January through April that got bid out of the market, to circle back to those folks, because now they have negotiating power again. And it's a great time to get them back into the marketplace. Without any further ado, we'll go ahead and hop into the numbers. The numbers that I report on cover the 7 metro Denver counties. So I talk about Adams, Arapahoe, Broomfield, Denver, Douglas, and Elbert counties. I get a lot of questions about Boulder County and about El Paso County. Those MLS systems are a little bit tricky for me to work with. I can't extract the data quite the same way that I can from RE Colorado. So I just focus on the heartbeat of where I focus my business on, and that's Metro Denver. Now, again, looking at all prices, our historical way that our market would work pre-COVID, it was that we would have a really big pop of activity that happened going from March through May. And this year, our market ended up going earlier this year. And this is a week by week comparison, or our heat sheets that talk about if the market is heating up or if it's cooling down. And with interest rates going up at the very beginning of the year, it created a lot of buyer demand earlier this year that would typically exist in the spring and the summer months. So our buyer pool was absorbed earlier this year, and our market really started to take a decline as we hit Easter weekend, which was probably about 3 months earlier than what we would typically expect. We've watched the market continue to decline after these 3-day holiday weekends going through our summer months. And we haven't seen the same rebound the week directly following these summer months. And this is unlike what we saw last year. Whereas last year, we ended up seeing that there was a rebound after 3-day holiday weekends. And we had an extended selling season because interest rates were so favorable. That didn't happen this year. And we really took a hard shift after Easter weekend. Again, this tracks the inflow and the outflow of new business and showing activity. And each time I tack on a new row, it becomes more and more blue, indicating that our market is continuing to cool. This is a great map for you guys to use when you're listing properties next year as to when the sweet spot is in the market. So if you have buyers or sellers that are saying, when's the best time for me to be in the market? This gives you a week by week analysis of how the market heats up and cools down over an annual cycle. Next year, what I'm hoping is that we drift more back into what it looks like for a more normal seasonal cycle, where we're heavier in March, April, and May, as we start to stabilize and as interest rates start to stabilize, if they stabilize going into next year. But this year was an early selling season, so you had to be on the market early this year. Looking at what's been happening just in this last week, our month supply of inventory went up to 1.2 months worth of inventory, which is up from last week. We're watching that number steadily rise, as it typically does through the summer months. Month supply of inventory is basically the relationship between supply and demand in our buyer and seller pool. A 6-month supply of inventory would indicate that we're at a market in balance. Anything less than 3 months worth of inventory is considered to be an extreme seller's market. With 1.2 months worth of inventory, we're definitely still in extreme seller's market territory, but it's not the 0.2 months worth of inventory that we were experiencing back in January and February. So again, having to have that conversation with your buyers and sellers, and your sellers specifically, that you might not be under contract in the first weekend. A couple of weeks ago, I had to have a conversation with a seller for a $2 million property in Wash Park that had been on the market for 4 days, and they were freaking out that they didn't have any offers. And so again, the market has cooled substantially since January and February, and you've got to start relaying that information to your sellers, saying you've got to keep your home show ready for probably 2 or 3 weeks. It's going to take some time, and we should probably go ahead and stage this sucker so that it looks really good for when people start coming through. Our average daily active count is now just shy of 6,000 available listings for sale, which is 6 times higher than what we had back in January and February. And so we've got 6 times as much inventory in the marketplace right now, which created this shift in affordability and the shift between supply and demand that's opened up for contingent offers, appraisal gaps, and inspection resolutions to go away. Now, we're putting probably about 1,200 units under contract each week. Week over week, that fell by 4.7%. Our contract activity is going to start declining now that we're post 4th of July holiday weekend, and it's likely to continue to decline through the end of the year. I've had a lot of questions about, well, I know the market tends to stabilize based on the data that you provide starting in September, October, and November. Should I list my home for sale now, or should I go ahead and wait until September when things start to stabilize? And the truth of the matter is that we still put more units under contract now than we do in September, October, and November. So I'm still advising you, get your listings to market as soon as you can. As soon as kids start returning to school and post Labor Day weekend, the market really tapers off through the end of the year. So it's important that you're getting your listings to market as soon as you can. We tend to experience a little shift as we go through July, August, and September, where prices retract by about 4 to 5%. So if you have peak comps that you're using that went under contract and or closed back during those spring months where it was insane and we were seeing people giving up their firstborn child to get a property under contract, that you're taking 5 to 7% off of that asking price because the market has retracted since then, and you really have to pull back in your pricing strategy. I'm not seeing a lot of back on markets. Back on markets have remained very consistent. We're watching about 8 to 9% of our properties go under contract and then fall back out. Historically, that number hovers around 15%, so we're still far below that number that I would typically expect for our fallout rates, okay? Now, looking at our odds of selling, and how many of you have taken Ninja? A lot of you, great. And so this is a Ninja number. This is something that you learn in Ninja installation. This is basically the relationship between all of those available listings for sale versus those that go under contract in a given week, projected forward for a 4.5-week period of time to say what the odds are of you selling in that given 4-week period. Now, based off of the odds of selling, this number continues to decline, and it actually went down 3.3% this last week. And so again, with more inventory making its way to market and sticking around for a weekend or two, our active supply has gone up and we're seeing fewer units going under contract. So our odds of selling are continuing to go down. Usually what happens after these 3-day holiday weekends is I end up seeing a little pop of activity that happens, but that hasn't happened this year. It continued to decline after these 3-day holiday weekends, and through the end of the year, it's likely to continue to decline, but we're now down to 57.3% odds of selling versus where we were back here in January and February, where it popped up to 87.3% odds of selling. So we're about 30% off of where we were just 4 months ago. So again, it's really important that you're conveying to your sellers that are looking at comps and saying, well, Bob's house down the road back in January sold for X. I want to sell my home for X plus 5%. The market isn't bearing that type of transaction anymore. So it's important that you're pulling back in your pricing strategy. Again, this number is down 21.6% from where we were 1 year ago, indicating that last year we had an extended selling season. Again, our buyer pool was absorbed early this year, so we're not seeing the same level of market activity that's happening later in the year. We're still far from a market imbalance, and I keep hearing people say, well, I've got buyers that say that they want to wait until the market crashes, and they're going to pick up a property for cheap, and they're going to wait for interest rates to go down, or they want to wait until next year when they think the market's going to cool more. I don't think the market's going to cool more next year, because what happens is we go into September, October, and November, people start to withdraw their listings from the market and our active inventory goes way down, and we're going to see less inventory next year as we get into January, February, and March, and we'll have our big spring pickup again. That means that we're going to have substantial price appreciation again next year. We've had near double-digit appreciation for the last 10 years in a row, and 90% of that appreciation is established between January and June each year. So if they're waiting until next spring when a whole bunch of new listings start to make their way to market, they're going to find themselves in multiple offers again as we get into those spring months. Now, if interest rates hold steady, again, that means that we're going to go back into a more normal seasonal cycle where we're really heavy in March, April, and May. But what happens if interest rates drop? That creates another spawn of buyer activity, right? And so again, we're likely to see that large substantial price gain going into next year. So it's not in their best interest to wait. And what happens if interest rates go up? Then that means their affordability tanks even more going into next year with higher price appreciation. I did a quick little analysis, and right now we're sitting at about an $800,000 average sales price. If we're looking at the same type of appreciation that we've seen for the last 10 years in a row, we're looking at about an $880,000 average sales price by the time that we hit May of next year. That's very plausible for that to happen. But again, waiting for a market to crash, this graph is a great way to show people we don't have the economic factors in play that would create this type of market decline. Now, again, the crash that created back in 2008 through 2012 was substantially different. We had 36,000 active listings going into that market, whereas right now we have about 6,000 active listings. Whoops, hitting all the buttons. Whoops, whoops, whoops. Okay, so we have about 6,000 active listings in the market right now. To create a market imbalance with a 6-month supply of inventory, we need to have about 30,000 active listings in the market. So that means that we only have 20.2% of the inventory that we require to offset demand. In order for a market to crash, we'd have to transition over into a buyer's market, meaning that we have to have more than 6 months worth of inventory. So we'd have to be north of that 30,000 number in order to get to a market imbalance. Plus, we'd have to have a lack of equity in our market. And again, people have been experiencing near double-digit appreciation in their homes for about 10 years now. So if a homeowner finds themselves in some level of distress now, unlike what happened back in 2008, they're able to list their home in still a very good seller's market, sell that home very quickly and walk away with that equity and not take a hit on their credit like they did back in 2008, where it was instantly upside down and they had to convert to a short sale, a foreclosure, or a HUD home. On top of that, we don't have any economic widespread hardship that's happening right now that's causing a loss of unemployment. Our unemployment right now is what? 3.6%. Okay. A healthy, stable unemployment rate is about 5%. So we're south of that number. It's basically fog a mirror, get a job. Okay. And so it's not like we're going to experience this big crash of our market like what we experienced back in 2008. The type of economic factors are very different. So it's not in your best interest to wait to buy a home next year because we're likely to experience similar appreciation going into next year as well. Now, the rate of showings has really dropped off, and this encompasses showing time showings. I'm still fighting with Broker Bay to try and get data out of that system. In order to get one number out of that system, I would have to run 45 searches. It's really painful. And so I can't do that on a weekly basis right now. So I'm talking to the powers that be, and they're trying to revamp the way that their showing time or their showing data exists. So hopefully in the near future, I'll have something better to report on for that. But right now we're kind of fudging it and adding a couple of showings to it just to make sure that you're getting some accurate numbers. But based off of data from showing time, last week, if you put up a new listing, you would have had 2.4 showings on that listing, which is a stark difference compared to where we were back in January and February, where you were getting 24 to 25 shows per property per weekend. So I've had a lot of people call me and say, I just put up a new listing. I only got 4 showings on it. What's happening out there? And there's a great report in showing time that you can pull called the target market analysis. And you can actually pull and see how many showings happened last week in a given zip code at a given price range so that you know if you're on target or not, because showings really lead the way and they let us know what's happening with demand right now. But based off of showings, they're going down, and that was down about 8.1% from where we were last week. The rate of showings tends to decrease as we go into the later part of the year with fewer people out there looking at homes. I've had a lot of questions about, well, can you tell how many buyers are in the active pool right now? And if we're getting about 15,000 showings per week, let's say they look at 3 homes per week, we've got about 5,000 buyers in our pool right now with about 6,000 homes to sell those folks. Okay, and that makes sense with the relationship between supply and demand to say that there's about 5,000 active buyers that are in our market right now. But showings have gone way down. So again, you need to start setting that stage with your sellers that you may not be under contract in the first weekend. It's not like the market that we had back from January through April, where it's really calmed down out there. Again, you get your life back as a real estate professional where you're not at the mercy of what hits the MLS every single day. Now you're able to take a more leisurely approach and go show properties on the weekend in a more controlled environment than what you were doing back in January, February, March, and April. So hopefully that gives you some time back in your life. But again, 2.4 shows per property if you put up a new listing last week. Based off of how many showings it takes to go under contract, we're now sitting at 12, and 12 is held relatively consistent for the last 3 or 4 months now, where it takes about 12 showings to go under contract. So if you're getting 2 or 3 showings per weekend, and it takes 12 showings to go under contract, that means that you could be on the market for 3 or 4 weeks, right? Now, back in January and February, what we were advising is that if you weren't under contract in the first weekend, you're probably going to need to make a price reduction to go under contract in the second weekend. Now that it's taking longer to get people through houses, we're telling people it's time to slow down the rate of price reductions. That if you're not under contract in the first weekend or two, it's okay. But weekends number 3 and 4, it may be time to reconsider what your price is, and your goal number is 12. If you've hit 12 showings and you've had no offers, that's probably the point that you might need to consider a price reduction. Now, price reduction information we'll talk about in a couple of slides, but the price reductions that I'm seeing right now in the market are pretty substantial. They're not these small little kind of cherry picks off the top for price reductions, but I'm seeing big, deep cuts to get back in front of the market this year. So again, it could be on the market for 3 or 4 weeks, unlike what we were experiencing earlier this year. Days on market is now sitting at 10 median days on market. So half the homes are under contract in about 10 days. That's up from the 4 days. And this is one of the numbers that the media has really globbed onto, where they're saying that median days on market or average days on market is more than double what it was back in January and February, or that it's up 120%. We like to talk in percentages because it sounds really sensational, but 11 days on market is not a long time, okay? Now, again, if we look at this number historically, this number is closer to about 35 to 40 average days on market when we look at this number over the last 20 or so years. 11 median days on market is still a great market. It's just not quite the market that we had earlier this year, so don't panic. Looking at price reductions, I'm seeing the rate of price reductions has increased, okay? Now, this is based off of what went under contract last weekend. And based off of data that went under contract last weekend, it was about 35% of them made price reductions before going under contract. Typically for the month of July, I end up seeing about 25% of homes make price reductions. So I'm seeing more widespread price reductions this year. There were about 64% didn't have to change their price at all. The rate of multiple offers, and this is something that I talked about last week, but for closings that happen in May, it ended up being that something between 70 and 75% of them sold for over asking price. As of closings in June, it was only 20% of them closed for over asking price. So the rate of multiple offers has slowed by nearly 50% in our marketplace, which is a big change from where we were earlier this year. Now, again, I'm seeing larger price reductions, and based off of data from last week, the average price reduction was 6.1%. Historically, for the month of July, we look at closer to a 4.9% price reduction. But what I'm seeing is people are making larger cuts to get back in front of that buyer pool and to offset some of the affordability issues that we're seeing in our marketplace right now. And so I'm seeing a lot larger price reductions, whereas historically, when we went through a market shift, I'd see more widespread price reductions, but at smaller amounts as we chased the market down. Agents are making bigger, deeper cuts, and that equates to about a $47,000 price reduction on an average priced home in Metro Denver, which is around $800,000 right now. So those are really substantial price reductions that we're looking at in our marketplace. You have to cut down into a pricing tier in order to get more buyers into that pool of potential buyers, in order to get that home out in front of enough eyes to get it back under contract. Now, I've also gone through and broken this out for you into $500,000 price tiers. Now that I've explained everything in deep detail, I'm going to go through very quickly the $500,000 price brackets for you so that you guys have those numbers leading into this next weekend. Now, everyone will get a copy of this report. So I see a lot of people feverishly taking notes. Don't worry, I'm going to give you a copy of this report and you are on my distribution list until you die, okay? And so again, everyone gets a copy of this. Don't worry too much about it. So 27% of our properties are under $500,000, and we haven't seen quite the same cooling trend. There's been a lot of downward pressure onto lower priced properties as people get priced out of the $750,000 home. Now they're looking at homes that are under $500,000. And so we're seeing a lot of downward pressure where buyers are moving down into a pricing tier in order to get into a home. And mostly a lot of these first-time home buyers are existing into this $500,000 bracket. We're still sitting at 0.7 months worth of inventory, which indicates a high likelihood of multiple offers, but that's up from the 0.1 months worth of inventory. At one point, we had 3 days of inventory in our market. 3 days back in January and February. That meant that at the existing rate of sales, we would sell out of all homes under $500,000 in 3 days or less. Now we're up to 0.7. So that means that it's about 21 days. Okay. So again, it's a lot better for us to be in this market than we were back in January and February. We have about 1,100 active listings. That's up 14.3%. And again, it's not because we have a lot of new listings making their way to market. It's because we have inventory that's now aging and listings are sitting on the market for longer than one weekend. We put about 400 units under contract each week. That fell this week by to 5.7%. So again, this market is starting to cool substantially as well. The odds of selling is now down to 69.4%, which is down from the 88% that we had earlier this year. We're now back to where we were pre-pandemic levels. Back in 2020 is about where we are for the odds of selling. Looking at the percent of balance, we still only have 11% of the amount of inventory that we require to offset demand in this market. We would typically need to have about 10,000 to 11,000 active homes in the $500,000 price point in order to offset demand. So I'm not looking for a market correction in this particular price band either. With showings in this price bracket, we're looking at about 4.1 shows per property, and that's down by 10% week over week. So after Independence Day weekend, I didn't see the big rebound in the number of showings. But again, I'm continuing to see this slow decline as we get into the later part of the summer months. But we set about 5,000 showings last week in this particular price range. We're still looking at about 12 showings to go under contract in this pricing tier. So again, if you're looking at 4 to 5 showings per week, and it's 12 showings to receive a contract, you could be on the market for 2.5 to 3 weeks before you go under contract in this under $500,000 price segment. Median days on market is now up to 7. So if you're not under contract in the first weekend, don't freak out. Give it some time, but about half the homes are under contract in the first week in this particular market. We saw 26% of the homes that went under contract in this market make a price reduction, and the size of the price reduction was about 6%. So again, pretty hefty price reductions, or about $25,000 off of their original asking price in order to go under contract. So 1 out of every 4 homes is reducing their price at this price point. In the $500 to $1 million price segment, this is by far our largest price segment. It represents about 60% of all the homes that are in our market right now. Looking at this, we ended up seeing that our cooling trend really started to settle in over Easter weekend back here in April, where we started to see some of these blue cells creep in, indicating that the market was becoming less competitive. In this market, we're now up to 1.4 months worth of inventory. So that means for every 1 buyer in the market, they have 1.4 homes to choose from. So we're out of multiple offer territory for the most part in this particular price range. We have about 3,800 active listings, and that's up 8.3% week over week. We're putting about 600 units under contract each week, and that's down by about 5.2%. But there's been a big shift in this market, and this market is our most loan dependent segment in our marketplace. And so with this being the most loan dependent market in our marketplace, that means that they're more subject to what happens with fluctuations in interest rate, because it's about 85% of them require financing in order to get into a home. So watching what happens with interest rates, if there are interest rate hikes that happen again in the next coming weeks and you're not under contract, you might have to make a price adjustment based on interest rates going up so that you can recoup that pool of potential buyers to go under contract again. The odds of selling dropped down to about 54%, and that's below where we were pre-pandemic. Pre-pandemic, we were sitting at about 61% odds of selling, and now we're down to 54% odds of selling. So it's a little bit lower than where we were back in 2020. And again, that's a lot in due to affordability issues. We only have 23.7% of a market in balance. So even though that number is higher and we're trending closer towards a balanced market, it's going to take us a long time to go from 3,800 active units up to 16,000 active units, which is required to offset demand. We don't have enough homes in this market to warrant some sort of type of price reduction or large widespread loss of value in our marketplace. If you put up a new listing last week, you should have received 2 showings on it based off of what we were looking at back in January and February. Again, it was 24 or 25 shows per property, but now we're looking at about 2 shows per weekend. So again, the rate of showings has gone way down in this particular price band. We're looking at still about 12 average shows to go under contract. So you could be on the market for as long as 6 weeks before you go under contract. So again, don't make price reductions too soon, but you may need to make a price reduction in week number 3 or 4 if you're not under contract. We're sitting at 12 median days on market. So half the homes are taking about 2 weeks to go under contract right now, which is longer than where we were back in January through April, where it was about 4 median days on market. So that number is about 3 times as high right now as it was earlier this year. Looking at price reductions, only 39.1% of them made price reductions. I've got a typo in my slide right there. I'll have to fix that. So it was 39.1% of the homes made price reductions last week. So again, nearly 40% of the homes that went under contract last week had a price reduction, and the size of the price reduction was 5.9%. So again, nearly a 6% price reduction, or about $44,000 off of the original price in order to get back in front of the market again. For homes between 1 to 1.5 million, our cooling trend again really started to settle in as we got into Easter weekend, where the blue cells started to creep in here, indicating a cooling pattern in our marketplace. We're now up to 1.5 months worth of inventory. And so that means for every one buyer in the market, they have 1.5 homes to choose from. We had about 538 active units on a given basis, and that's up by about 3.7% based off of where we were last week. Pending transactions fell by about 6%. So again, that supply of inventory is going up. That number is likely to continue to grow through the end of the year. Odds of selling is sitting at 54.4%, which is still better than where we were pre-pandemic. A lot of homes have appreciated from the under $1 million price point into the over $1 million price point now. And so we've got a lot more homes that qualify in this $1 to $1.5 million price range than we have had in past years. But we're still looking at a 54.4% odds of selling, which is not a bad number, but it's down from the 74% that we saw earlier this year. So it's about 20% less likely that you'll go under contract in the same month than it was earlier this year. We're only at 16.6% of a market imbalance. We had 538 homes based off of what went under contract last week. We'd need to be closer to about 32 to 33,000 available homes, or not 33,000, 3,200 homes available for sale in this market in order to create a market imbalance with a 6-month supply. We were also looking at about 2 shows per listing. 2 shows per listing seems to be pretty common across all the price points right now. But if you put up a new listing in this price range and you got 2 showings on it, you're right in the sweet spot in the market and you're getting enough showings on those properties. It took about 13 showings to go under contract. So again, you could be on the market for as long as 6 weeks before you go under contract in this price range. So again, making those homes as beautiful and show ready as you can to make sure that the curb appeal really pops on these properties is going to put you into a better position to get your properties under contract. Median days on market was sitting at 19.5. And so again, it was taking nearly 3 weeks for these homes to go under contract in the $1 to $1.5 million range, with half of the homes under contract and longer than that. Price reductions, it was 46% of them made price reductions based off of what went under contract last week. That's pretty substantial, you guys, where we're seeing a lot of price reductions that are happening in this particular price point. And the size of the price reduction based off of data from last week was an 8.3% price reduction. As I go up in pricing, I end up seeing larger price reductions being made, somewhere between 8 to 10% once I go over $1 million, so that people can drop $100,000 off of their asking price. But an 8.3% price reduction for homes between 1 to 1.5 million. Let's see. For 1.5 to 2 million, again, the cooling trend really started to settle in right about Easter weekend, where things really started to pull back in our marketplace. We're now sitting at 2.8 months worth of inventory, and we haven't seen 2.8 months worth of inventory since we were pre-pandemic, where it was hovering around 3 months worth of inventory. So that means for every one buyer in the market, they have about 2.8 homes to choose from before. So we're out of that multiple offer territory that we saw back in January and February. At our lowest point back here, it was Super Bowl weekend. We got down to 0.5 months worth of inventory, or about 2 weeks. Now, again, we're sitting at about 2.8 months worth of inventory, and that number continues to grow. Our active inventory is holding relatively consistent at about 200 units available for sale, but it's our pending transaction count that's really starting to taper off, with about 26% fewer units going under contract this week than what happened last week. Our odds of selling dropped down to 37.3% odds of selling. And again, that's back to where we were back in 2020 pre-pandemic. So again, we're looking more like 2020 now, with higher interest rates and more inventory in our marketplace than what we had over the last 2 years. We're only at 23.3% of a market imbalance. So even at the higher price ranges, I'm not looking for a market correction. I don't foresee that in our immediate future. Until we get a lot more inventory in our market, we're not in place for a market crash. It was about 1.6 shows per property per week at the $1.5 to $2 million range. And it was taking 19 showings to go under contract. So it's taking longer to get people through these homes. So again, you could be on the market for as long as 10 weeks in this particular price range before you go under contract. So slow down your rate of price reductions, wait a month, wait 6 weeks before you make a price reduction, and make sure you get enough people through that house before you start to reduce your price. Median days on market dropped down from 19 last week down to 11 this week. So we're looking at about 11 median days on market. Price reductions was about 35% of them that went under contract last week made price reductions. And the rate of the price reduction was about 5.9% or about $100,000 off of the original asking price. I should probably take a breath at some point in here. That covers everything that I wanted to go over with you guys today. In a nutshell, the market is really cooled and it's substantially different than what we were experiencing back earlier this year. It's important that you guys are really setting appropriate seller expectations for your clients and explaining to them why their home's not going under contract in the first weekend. And again, to get those homes as curb appeal and show ready as possible. And it's going to take some selling skills and open houses and just listed cards and all of the things that we used to do pre-pandemic to get those homes under contract again. So take your time with your listings, make sure that you're pricing them appropriately. If you price it right the first time, it sells faster and for more money. So make sure that you're doing your due diligence and pulling back in your pricing strategies.
Thank you.
Thank you.
Breathing? That's it. We're good. Did everybody catch that? Okay. We got two really quick questions from online, which you can answer very quickly. What was the name of that report available in showing time?
So the showing time report that you can show how many showings they got in the last week is in showing time under reports, and it's called the target market analysis.
And then Clark asked, could that number on the under contract with price reductions actually be off because people are offering lower than list right now?
So it could be, so I can track price reductions. I can't track close to list price ratios until they close. And so that data ages, it's old by about 30 to 45 days by the time that I get it. And so if people are negotiating or offering less than that asking price, I capture that in the monthly report because it takes me a month to go through and capture that information.
Lovely.
Thank
Not
you.
go that way.
Oh, go this way.
All right. So what is happening, right? And I'm louder than Megan, so you should be able to hear me in the back. All right. So everything that she just said, we're trying to make heads or tails of it because 1 week we feel like we're getting a slight uptick. We saw the interest rates drop for a minute because I know I went live on Facebook talking about the fact that we just locked a handful of people at 5.375. And that was really fantastic. And then it was gone, right? So that quickly the market is moving. So how do you make heads or tails of it and help your clients see what's coming up, right? And my team does a lot of work doing that. We talk every morning about what's going on in the economy so that they can speak to your clients and get them out of fear and back into action. Because the worst place they can be right now is on the fence. Can we all agree with that? Right. So that you might have fewer of them, which just means you have to love on them more and get them off the fence. Right? Because next year is going to change, as Megan mentioned. So kind of want to go over a couple of the economics and what's happening kind of behind the scenes. Last week, we talked about the roller coaster we rode through the CPI and then the PCE, the two inflation numbers, right? Remember the CPI came out higher than expected. The Fed was sequestered at that time, so they couldn't come out and talk about it because their meeting was about to happen. So then the market just took off with all the expectations of what was going to happen. Market data does not move markets. Expectations of market data move markets. And so when the Fed couldn't come out, the markets changed rapidly. We lost almost 3/4 of a point in interest rate in 3 days. Then the PCE came out. So the Fed is meeting next week. What are they going to be seeing? What are they looking at? They're looking at commodity prices starting to come down. They're looking at some of the transportation and manufacturing numbers starting to slow down. They're starting to see some of the inflationary numbers starting to slow down, right? Housing starting to slow down. So they're starting to see this. So the question is are they going to raise the Fed rate 0.75 or 1%? And what is that going to do to the market? Really, as long as they raise it 0.75 or 1%, we're all talking about it already. I don't actually expect interest rates to go up next week because of it. I think we've already baked it in. We're already talking about it. It's what they're going to do in September that's going to, what we're going to be listening to what they're going to do in September. So this right now shows the home builders. So NAHB puts out this report showing the home builder confidence plunged, right? That went all over the headlines. So what's happening with the new home market? Now remember, their segment's tiny. We're talking about like 500 to 700,000 units compared to 5 million plus units on the existing home sales. Existing home sales are cheaper and more regularly available. They're everywhere. They're not in new home builder communities. So they're kind of the competitor for these builders. And they did pretty well last year. I know lumber went up, but they passed it on. I'm building. I got charged, right? They didn't get, I did. So they got behind the 8 ball right in the beginning when all the prices went up and they'd already locked in people. But after that, they started to make it some really good money last year. So all of a sudden, the home builders' confidence is going down. Of course it is, because it takes so long to get a new build to market, especially in this economy, that those people that were locked in at 3% that made that decision are bailing at 5.5%. So they've got some fallout. They got to get it back on the market. Maybe they can't charge as much. And now they're just slowing down. They're like, I'm going to wait to see, because new builders really like low interest rates. But what happens to the existing home market with low interest rates? Bloodbath. We saw it happen the last 2 years. We don't want that again, but if that's what it takes to get the builders happy, I don't know that I want that trade-off. So housing permits were down 0.6% month over month. Single families were down 8%. But realistically, we're still tracking. They're still doing homes, right? They're just doing them slower. But the 0.6% month over month reduction in the housing permits is telling us that we might actually get some recovery for the rentals. We need people to have access to housing, and more rental housing opportunities will drop rental rates, which are going through the roof right now. But the fact that single families are down 8% is all of those home builders tapping on the brakes, waiting to see what the market is doing and to run off the rest of their inventory. Housing completions, though, is flat because it's taken a while to get to market. They're just rolling off what they've already got in their process, right? So all of this is happening. And of course, the single families, we're seeing less inventory. So this is what's actually frustrating. And this is what's talking about all of those people that had to bag out of their contract because the interest rates went up. Existing home sales report just came out. You guys saw that from NAR, and it's down significantly. That chart looks awful. Like it literally looks like it's falling off the graph. So we're feeling that. So existing home sales are also down because demand is down, right? So we're seeing the inventory. So this annualized 5.12 million, down 5.4 month over month, 14% year over year. All of this is because of demand, not necessarily because of inventory. We're seeing more inventory, all 1.19 months of it. We're seeing more inventory because we are seeing those buyers hold back. We're seeing those buyers that might just 75% of the people who are mortgaged have an interest rate less than 4%, sorry. Right? 75% of those people who have a mortgage have an interest rate less than 4%. I'm not quick to give that up. And I'm just going to stay put. And maybe I'm not going to resell my home. And another, 38%, 62% of homes are financed. The opposite, 38% are owned free and clear. So that's why we're actually seeing reverse mortgages picking up, because the baby boomers are now aging in place. Gabe Bodner is in the back of the room. If anybody wants to talk about reverse mortgages, nobody better, right? So all of this is going to continue to taper inventory. So as we're seeing this, the demand is down. So this was the headlines. Mortgage applications hit a 22-year low. You guys saw that headline. I mean, it was everywhere, CNBC. Everybody was carrying it. So if you look at this line, I drew the blue line. If you look at that line, it's right. Mortgage applications are 22-year low, but a lot of that is refinances. So that spastic, the light gray that you can kind of see, the light gray is actually the mortgage applications. The purchase applications is much more consistent because people buy based on their families growing, right? Retiring or whether they're graduating. They buy based on life events, not based on interest rates. So while the refinances is like way down, purchase applications are still consistent. Now, they are down, they're just not nearly down as much. In fact, we saw a huge dip in 2020, but we actually have more purchase applications going on than we did all through 2020 or 2010 to 2017. So we have a strong market with buyers, active buyers. We have to start comparing this year to 2019. Stop comparing year over year to 2021 and 2020. It's not fair because it's freaking out our buyers and sellers. If we go back to the fact of how was our business in 2019 and compare that and help them see the mass amount of equity that they've gained in the last year, that's the win. So when you're sitting down a listing appointment and they really want, as Megan said, they want the money that their neighbor got, then you have to show them how much equity they gained from last year or how much equity they gained in the last 2 years. Coming down a little bit, they're not losing money. They're simply getting more in alignment with the market. So good news from the sales report, so the existing sales report also showed that first-time home buyers is 30% of all of the sales. It was actually down year over year, but it's up month over month. It was 27% last month. So the first-time home buyers are still buying. Everybody says that they're not, that they're hiding, isn't looking at the data. It's perspective. Don't get all negative on this. First-time home buyers is still strong, 30%. Investors is 16%. That's actually up. They had their biggest equity quarter, the first quarter of this year. Investors are still buying. If you have investors in your pool, you should be talking to them. Now, the investors that have been buying for the last 10 years, they're not buying. They're like, oh my, no. Like I can't get a 6% cap rate right now. I'm like, no, you can't. But that new investor that wants to buy that next primary, that wants to take that last primary and turn it into an investment, or that one that wants to, I've got one right now out shopping, looking for a duplex, and we just had conversations. Christy, if you're in the room, yep, right? Was looking at a single family. Now we're bringing that up and looking at a duplex because we know home prices are going to continue to go up. Does it cash flow? Does it even break even? Don't buy it if it doesn't break even, but does it break even? And can you continue to gain on that? Change the conversation. Don't get sucked into the headlines. Talk about the opportunity. Home values always go up. Active inventory is still low. Everybody keeps talking about this swish at the end. It's the speed by which, right? The speed by which inventory has come up here, come up nationally. But look at it. The speed by which compared to what? We still have record low inventory. This is not a buyer's market. It is still a seller's market. So having those conversations, the buyers just think it's a buyer's market and they're making your sellers think it's a buyer's market, right? But it's still a seller's market. So having this conversation with them, and of that number for NAR, 51% of those are already under contract. So we actually have half of that because they include those under contract numbers and the new builds that aren't complete. So we've got to get to a point to where our inventory, and this is a nationwide number, it's not Megan's numbers for local, but nationwide, we got to get to a point where we have more inventory at the end of the year and we start the spring season with a leg up in inventory. And right now we only have more inventory than we did the last 2 years. We don't have more inventory. As you can see, this dotted red line is the projections. We only have more inventory than we did the last 2 years, not the last 6 years before that. My fear in all of this is, and I differ a little bit on Megan, where I'm a little worried about next year. I think we're going to go into a regular spring season. I think we're going to go into a regular buyer season where it's going to feel more normal. But if sellers are worried today and they're pulling their listings forward, right? Because I got to hurry up and sell because my agent is telling me that now is the best time and we don't know what the second half of the year is going to be. And if I'm hurrying up and getting my listing on the market, which is helping us get to the 1.1 months of inventory, and we crash and we don't have nearly as much inventory at the end of the year to kickstart 2023. And if the economy slows down enough, if the Fed actually does raise the Fed rate 1% next week and 0.75 in September, and we do go into an economic slowdown, which we're already starting to talk about, I think we're going to see interest rates go back down. And if we see interest rates go back down, what's going to happen to that light inventory that we're walking into 2023 with? Are we going to create another frenzy? And how are you talking to your prospective buyers right now? Are you telling them to wait until the interest rates go down? Or are they telling you they're waiting until the interest rates go down? Because now you're just going to put yourself right back into the mess that you couldn't get in for the last 2 years. No, get in now and refinance later. Because if you're a would-be wannabe home buyer, you want to be in front of that, not behind it. You want to take advantage of the equity gains if all that plays out. Now, my crystal ball was broken a long time ago, but that's how I see it playing out. And that worries me a little bit, although I'm going to be really busy. So there's that, right? Because we do, as you recall, I want to make sure I double click on this. We do have the refinance guarantee where if interest rates do go down, you guys need to all be sending your business our way. Both Megan and I. Where did Megan go? She's hiding on me. There you are. Why we do this, right? Fixed rate mortgages. The 30 years starting to converge, and I'm going to show you the 10-year treasury here in just 1 second. But everybody's talking about this orange line on the bottom. The orange line on the bottom is Freddie Mac. That is always delayed by 3 to 5 days and includes a 0.8 discount. Nobody talks about that in the news. They just talk about the fact that interest rates are going down or interest rates are going up. So if you actually look, how did you get that little red line thing working? Oh, look at that. Cool. Okay, so if you look right here, the interest rates were actually going up. I don't have to pick out the data of the situation because it doesn't matter. But the interest rates were going up. I was calling clients. I was talking about the fact that the interest rates were going down. The news picked up that the interest rates hit a bottom. So the news cycles, the headlines were saying interest rates just hit a record low for the last month. And then, but I'm calling clients saying interest rates are actually up. Their data is delayed. It's not bad, it's just delayed. And so if that's what the media is picking up, and you heard that, and you got that on the headlines, and I called your client and I said the interest rate's 5.875, but you read the headline that says Freddie Mac says the interest rates are 5.5. You need to go talk to another lender. Well, you just sent them out on a goose chase, and now they're going to be more frustrated by the end of that chase trying to find that 5.5. Meanwhile, that was last week. This week it's 5.875. So just identifying the right metrics to track and to communicate with your buyers, because I know they're all talking to you about interest rates because they're higher now. So the 10-year treasury is what I watch. It's converging. I added the blue lines. So as we saw that massive jump was with the CPI last month, and then the drop of the PCE, and now it's starting to stabilize. So people keep talking about interest rates hitting somewhere around 6 or 7, right? Right now they're about 5.625 this morning. People keep talking about the hitting 6 or 7 or even 8, I've heard. I don't see it. I'm having a hard time considering that we worked through the CPI issues. We're talking about the Fed's raising the Fed rate 1%. We're talking about the Fed's rate raising it again. We're already in quantitative tightening. And the last inflation number, which was higher than it's ever been at 9.1, and then the PPI number, if you watched last week, we talked about that. That's the producers index. That was higher than expected. It didn't move the rates at all. It didn't move the rates at all, because we already know that we're starting to see a slowdown in manufacturing. We're starting to see a slowdown in the commodities. And if we start to see a slowdown on that, inflation is going to come down. And when inflation comes down, interest rates come down, because interest rates do not like inflation. Inflation is the arch enemy of interest rates. So we're just waiting. What's happening? Now, we could get some really crazy news out of left field that makes the interest rates move again, but I don't see them jump into 6, 7, or 8. 6, if you're buying an investment property, you're already talking about 6. All right, really quickly then, we continue to just remind your clients about the strength of the housing market. Yes, a recession is probably coming. There is no bubble associated with that. It doesn't equate to the same. Everybody takes 08 and thinks they're the same thing. They're not. Every other recession, we saw housing continue to increase except for 1960, right? Even if it increases 1% a year, I'm happy with that. I'm really happy with that, right? Because of leverage. That whole $600,000, $800,000 is moving, and I only put $50,000 down. So right now, we've got 2.75% of all the homes are in delinquency. Foreclosures, we've got next to nothing. This was a little jump. It's interesting because I'm going to show you the Colorado numbers. This was a little jump right after the foreclosure moratorium ended, exactly, right? So then all of a sudden, these foreclosures were all put in, and then all of a sudden it drops right back down again. So those foreclosure sales immediately drop right back down. Colorado was called out as being one of the top 10 United States markets to having the foreclosures. We have 1,075 out of 1.4 million households. That's 0.07%. Put it in perspective for your clients. 0.07% of our homes, and I can't even imagine where they are because we need to go buy them, right? Who does that? I don't know where they are. All right, home vacancy rate, still record lows. I showed this last week, but just a reminder, it all goes together. So keep stockpiling the information, right? The vacancies are super low. The foreclosures are super low. Yes, we saw a little pop. Let me explain what happened. We had foreclosures in process before the pandemic. The pandemic shut everything down, and now they actually were realized. It's just delayed, right? So these aren't new. And then we have double the equity that we had in 2006. All people do have to sell, and God help me, I hope they don't sell. Just don't sell. Hold on to that home, whatever you have to do, because home prices are going to continue to go up. And the alternative is rents. So if we continue to see these new build rentals, that could be a good thing that slows this down. But anybody that's choosing right now, homeowners, I'm going to put this on the record. Homeowners are good. Homeowners are really good. They got plenty of equity. They got plenty of options. It's the renters we got to be working hard to get out of their rent and into a home. That should be everybody's goal every morning when they wake up. This report just came out this week. I could not stop laughing. God bless them. We're going to get all millennials into a home. Millennials who give up TikTok and alcohol for a dream home. Thank you, God. It's time. All right. So how do you make sense of this? New home seller sentiment is down. Inventory is still low. Estimates for 2023 are that we're going to get seasonal. I'm just worried about that pullback in inventory and then what happens if interest rates drop. We know that housing is stable during recessions. We know that this is our job. I hope you're sitting in this room because you believe it as much as I do. Otherwise, I would drive you crazy. Nobody wants to listen to me rant on and on about how positive the market is if they don't believe it too, right? We know this is our job. It's not to sell. It's to advise, to educate, and to support, right? My team does it every day. We work hard to communicate. We are in partnership with Brandon Ritter. If you guys don't know Comma Insurance, you need to talk to Brandon. We've got reverse mortgages, Gabe in the back. This is what we do every day to help your clients get to the closing table quickly, swiftly. And another trick, I'm matching rates. I'm tired of these chippy lenders coming in here online, stealing your clients. You work with me, I'm going to match their rate. I'm going to go down and I'll personally do a free loan to get them out of your hair. You don't like them any more than I do. Let's be honest. I will do every loan, every borrower you got in this room, I'll do free. I don't care. I don't care. So, yeah, wait, what? Yeah, Peter wants a paycheck. But before you can advise, before you can support, you have to find them. You got to build more clients. You got to build more awareness and build your sphere. That's why we've got the next set of speakers with us today. I cannot wait. We're going to start out with Jeremy Kane. Louis Galt is going to take over from there, and Mike Sherrard. We're shutting down Zoom. Thank you guys for joining us online. Love this. We're going to shut down Zoom. We're going to grab food. Some people didn't know that we're feeding you lunch because I don't stop short. You guys, anybody that was at Next Big Thing knows we go over the top, right? There's still confetti in my shoes. You guys grab some food really quickly, 10 minutes. Don't stop and chat. Check your email, sit back down. We're going to get started with the second half of this. This is a good time.